Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Will, I am retired. How should I be invested? Is the most common question I get from retirees. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management, and today I am doing something a little different. I'm all by myself, just me and a microphone. We'll see how this goes. I think this may be my mother's worst nightmare. I know that from the time they taught me how to talk as a baby, they've regretted that decision. So we'll see how this goes with just me and a microphone. But after almost 23 years as a financial advisor, what should we be invested in is the most common question that I get. And in my humble opinion, when it comes to wealth management, it's the worst question you could be asking. That should not be what is driving your wealth management decisions. Investments are important. Investments matter. Having your portfolio as dialed into your financial plan as possible is very, very critical. But how you should be invested, what you should own, is not the first question that you should be asking a financial advisor. It is not the first decision you should be making when it comes to wealth management, but it's important. So we're going to talk about it. How should I be invested right now going into retirement? And right now is a dumb question. Right now is the probably the worst thing of that question, because market timing never works. That's been proven time and time again. And even if you are the worst market timer, and you think about that as investing on July 1st, 2007, right before the financial crisis started and the market fell substantially from there, you still have had a pretty good return. And I want to look at that while we're talking and see what the S&P 500 performance has, because it was pretty high heading into the financial crisis. It was only is one of the worst words you can use in finance, by the way. Only. The S&P 500 in July was around 1,400. So if you made your first investment then, today, right now, as I'm recording this, the S&P 500 is a little bit higher than 6,700. So if you invested at the worst possible times, you're still doing okay, as long as you stayed invested. Remember, it's time in the market, not timing the market, that matters. So let's look at some other times in history now that I'm curious. Going into COVID and the response to COVID, we are almost exactly double where we were in January of 2020. We were at 3,300, almost 3,300 on the S&P 500. Today, we're at that 6,700. So if you made some of these decisions, if you invested right before September 11th, we were at 1,500 on the S&P 500. So timing the market is the worst possible thing you could possibly do. Time in the market is what's important. However, as we're going into retirement and thinking about how we should be invested, to us, there's three things that make the most sense, because we do know this. We do know you're going to need liquidity. We do know it's time to spend. We know it's time to enjoy the fruits of your labor. It's time to go see the world. It's time to create. It's time to spend and enjoy. So you're going to need money to spend, and you're going to need it soon. And we do know that the market's a wild place. We just talked about some of those statistics. So one of the key factors that you should be thinking about when it comes time to retirement and how you should be invested is, what do I need in the short term? What do I need for the next 12 to 18 months worth of income? And let's not risk that money. Now, you've heard these strategies probably called millions of different things. The bucket strategy is the most common. But let's take that and let's be as conservative and liquid as possible with that money, so that your income is not disrupted by worldwide economic events, by market events, by government shutdowns, by anything else that's going on in the world. We have 12 to 18 months of our income secure so that we don't have to worry. Because who wants to worry when you're retired? We left that behind in our cubicles. We left that behind at the office. We left that behind where we were working. We don't want to worry anymore. So let's not. Let's make sure that this income is as secure and predictable as possible. And let's be very, very conservative with that. And then we know the next 5 years. Maybe we know our plans for the next 5 years. That's where this second strategy comes into play. We know inflation could have an impact over 5 years. We've just come out of a very hot inflationary time in our economy, but we want to protect that. We still need it to grow. So we want to make sure that we keep the next 5 years, because especially early on in retirement, that's when we do all the traveling. That's when we go see the things that we've been waiting our whole lives to see, that we know we're not getting younger. We know we're not getting healthier. We're going to take the time to go do what we want to do, see what we want to see, and be where we want to be, experience what we want to experience very, very early on. So we want to keep that money growing. We want to keep that money with the exposure to the market. However, we don't want to be taking wild, speculative ideas with that money we need in the next 5 years. It takes a long time for market ideas to come to fruition. Ask the founders of Microsoft. Ask the founders of Apple. Ask Mark Zuckerberg. Ask anybody that's invested over the long term. It's not going to happen in 5 years. The best ideas don't. The best ideas take time. The best ideas culminate over a market cycle, and then the riches are made. So we're not going to put that at risk with giant speculative events or giant speculative investments. The place to speculate is in money that you may not need ever, may not need in the next decade, because it's going to take time. And that's that third bucket. So I know I give pretty boring answers because folks are saying, hey, Will, what is the hot stock idea that you have right now that is going to change my life? I don't have it. I don't think any of my peers have it. You know, when we get together and talk about our businesses and investment ideas and things, that's not what we're discussing. None of us are. You know, we're talking about how we're growing our businesses. We're talking about how we're providing the best service we possibly can to our clients. We're talking about investment ideas over the next 5, 10, 15, 20 years. None of us are talking about what's going to do well in the next month or the next 6 months, or what the new greatest idea is that we should be investing in. We're talking about long-term strategies that are going to make sure that when we're sitting in front of a 62-year-old, that we're remembering we're sitting in front of a 195-year-old. Two 62-year-olds becomes 195-year-old at one point. We want to make sure that that 95-year-old is not eating green beans out of a can and is not worried about where their next paycheck is going to come from. So you may have seen the thumbnail or title to this episode and thought, Will's going to tell us this is where our money should be going in the fourth quarter of 2025. It's going to be no different than in the fourth quarter of 2026, and it's no different than what we talked about in the fourth quarter of 2024, is to have a plan and have an investment strategy that is taking into consideration everything you're going to be doing into retirement, because it could be as long as your career. And that accumulation phase, we've said it on this podcast before, that accumulation phase is easy. Invest and close your eyes. Keep piling money in. Keep investing, keep saving, whether it's in a employer-sponsored plan, a 401k, a 403b, your IRA, your own individual accounts, whatever. The accumulation phase is not where the challenge becomes. It's that distribution phase. Because we know, as I started this episode, what the market does. If you started the accumulation phase at the worst possible times, you're still doing okay. You've still saved and earned a nice return over that long period of time. But when we get to the distribution phase, that's when our stomachs really start to hurt, when things go sideways. That's when our emotional intelligence really gets caught on the carpet. That's when we have to keep some perspective. And investing in that mechanism by keeping your short-term assets very liquid, very conservative, by keeping your middle range assets a tiny bit more aggressive, but growing or trying to grow conservatively, And your longer term investments, that's where you find and maybe have the stomach for some speculation. Or that's where you're adding risk because what do we know? We know a decade from now things are going to be more expensive than they are today. We know 25 years from now they're going to be even more expensive. We know that taxes are going to change on us multiple times throughout our retirement, specifically if we're 65 today. So we know that these things are going to be changing. And the one thing that we have that we know has been our best hedge against inflation has been the equity markets. We know that that's been our best hedge. So keeping that longer range money exposed to that your stomach may hurt sometimes. You may be questioning your sanity. You may be lying awake, staring at the ceiling. But if you take this approach and making sure that you are invested, considering your short, mid, and long-term income needs, you are going to be putting yourself at ease whenever things do go awry, because they're going to go awry. I'm getting ready to run a marathon in a couple weeks. And I know one thing. I know it's going to hurt. I know there's going to be some times that suck. I know that there's going to be some moments where I want to quit. I know there's going to be some times when the hills of the bridge of the New York City Marathon look insurmountable. But I also know that I'm going to have to approach every mile of that race a little different. I know that I'm going to have to deal with some pain, just like we know we're going to have to deal with the market, just like we know we're going to have a recession. That's a foregone conclusion. When? I don't know. But we're going to have to deal with one, maybe two, probably three throughout your retirement. How are we going to weather that storm? How are we going to make sure that we're not making bad investment decisions at the wrong times? How do we make sure we're not trying to time the market? It's by being disciplined with 3 different strategies for one portfolio, for multiple accounts. However you feel comfortable dividing that up, that's up to you. That's up to us to work with our clients. Do we do it all in one account? Do we do it all in one portfolio? Do we do it in multiple accounts? That's up for us to be comfortable with our clients. That's up to you to be comfortable with how you're handling it. But how are you going to set yourself up to handle the marathon of retirement? Is it just going to be hopefully finding the hot stock tip every month, every quarter, every year? That's listen, I do this as a profession, and that's not the way I want to live. That's not the way we want to help folks. I hope that's not the way you want to go into your retirement, is constantly finding the best idea, the hottest idea, because it's not always going to work out so well. Good ideas go broke all the time. I'm sure there's plenty of stories in the annals of history that will tell us this good idea went broke. How many times did Abraham Lincoln fail before he became president? Plenty. How many experiments did Elon Musk fail before he created Tesla? He didn't wake up and become a billionaire. There's a lot of failed things. Microsoft, first idea wasn't very good. Steve Jobs was fired from Apple. So making sure that you are taking a very disciplined, and it may not be fun. I may not give you a portfolio you can brag about to your buddies every time you're together and talking about hot stock tips. To me, that's toxic. That's poison. That's the noise that we are hired to help our clients rise above. We're hired to help our clients not have to deal with, because it can put you on a path to destruction if you're not careful enough. So that may not be the answer you were hoping to hear. You may have been hoping that you clicked on this video and clicked on this podcast and thought, now Will's going to give us the best stock, the best investment, the best sector, the best part of the market to invest in to make our money go up in perpetuity. Sorry if I let you down, but I do know that bucket approach, that multiple strategies as you're approaching retirement, will help you avoid sleepless nights, will help you execute some discipline, will help you achieve what you would hope to achieve. Have you seeing what you want to see, traveling where you want to travel, experiencing what you want to experience, and ideally, if it's in your mission, to leave a legacy that you do want to leave. So that's it for this episode of Wealth on the Move, the podcast. Hopefully, I did okay by myself. Hopefully, my mom listened and didn't roll her eyes and say, why did I teach this kid to talk? But if you need to reach out to us, please check me out on LinkedIn. I'm very active on there. Always, you can go through our website, hoffmanwealth.com. There's a discovery call link there. If you do have any questions or would like to reach out to us, I know there's more guests coming. We have a lot of that in the works right now. Some exciting things to talk about when it comes to our wealth and the things that are in front of us. But until next time, please remember to keep your wealth moving. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.